I bet I can guess how you feel about technical analysis. You either worship it like how Tesla fanboys view Elon Musk, or you hate it more than Mark Zuckerberg during his infamous Facebook privacy scandals. But are these the only two options? Technical analysis is a trading style that has people picking sides like Selena and JB's breakup. But what is technical analysis, and why do some traders swear by it while others call it BS? For a long time, I wasn't sure who to believe, so I did my own research and came to a conclusion. In this video, I'll be giving you a no BS unbiased explanation of how technical analysis really works, and whether it's a gift to humanity or a total scam. I truly believe a lot of people can benefit from the information I'm about to present in this video, so give this video a like so YouTube pushes it to more people. Let's start with the basics. What is technical analysis? The short answer is that it is a type of trading that looks at trends and trading activities to evaluate investments and find the best opportunities. Technical analysis tools are used to look at how changes in price, volume, and volatility will be affected by how much and how often a security is bought and sold. It is based on the idea that a security's past trading activity and price changes can be good predictors of how its price will move in the future when used with the right rules for investing or trading. The short answer is that technical analysis starts with a chart showing the price of a security, usually stocks, bonds, or options, over time. Certain tools are then used to analyze that chart. These tools are called indicators. The main idea behind technical analysis is to trade with the trend, and there's lots of different ways to find trends, hence the different indicators. So, if your indicators tell you the security is trading upwards, you sell. Indicators measure whether a security is trading, the strength of the trend, and when the trend is running out of steam. No indicator measures everything, and there are lots of them, but traders who use technical analysis will have a handful of personal favorites they rely on. Some indicators are focused on identifying the current market trends, including support and resistance areas, while others are focused on determining the strength of a trend and the likelihood that it will continue. Some of the more popular technical indicators and charting patterns include trend lines, channels, moving averages, and momentum indicators. I won't go too deep into these indicators in this video, but if you want to watch a detailed video about them, subscribe to the channel and turn on the notification bell so you don't miss it when it comes out. Technical analysis can be applied to any security with historical trading data. Generally speaking, the longer a company has been around, the more data on its prices, as well as the indicators which affect its price, are publicly available. The more data you have to work with, the better the models you have to work with. Or at least it seems that way. Because a complex model isn't necessarily an accurate one, but I'll explain what I mean by that soon, so keep watching. Some analysts track numbers other than price, like trading volume and open interest figures. While fundamental analysis relies on analyzing a company's financial statements to determine the fair value of the business, technical analysis operates on the assumption that a security's price already reflects all publicly available information and instead focuses on the statistical analysis of price movements. People like Warren Buffett stick to fundamental analysis because it's just far more reliable. And given Warren Buffett's net worth and reputation in the investment world, it's hard to discredit his strategy. But before we completely throw technical analysis out the window, let's give it a fair chance to see if it actually offers anything useful. Now, let's look at why some people absolutely love TA. First, the idea behind technical analysis is so damn satisfying. It's like eating a warm muffin or going to the bathroom after chugging 2 mugs of coffee. In other words, it gives us a huge dopamine hit. It satisfies the innate human desire to search for patterns, find meaning, and make more informed decisions based on those findings. It makes us feel powerful and in control, and who doesn't like that? TA compares current patterns with historical patterns, allowing, in theory, an investor to make accurate price predictions. It can feel like playing God with capitalism by essentially seeing the future. This is especially appealing to investors who think that the best way to trade is to find and use trends in human behavior through market psychology. In other words, they focus on what people think about the investment rather than its intrinsic value. Technical analysis fans believe that fundamental analysis, information, and research are already reflected in the price of the markets, so using TA can function as a huge time saver. Valuable minutes are spent becoming familiar with price movements instead of identifying what TA diehards believe is irrelevant information. This means, in theory, that more time is spent focusing on executing trades and managing profits and losses. That's why TA tends to be heavily favored by traders while investors use fundamental analysis. Technical analysis is also attractive to traders without access to a trading desk because technical indicators and software packages are relatively inexpensive. They make it easy for day traders to get started and give people new to the game specific things to focus on. It provides a foundation for building a good trading strategy that can be tweaked to each trader's needs and style. Once a trader grows familiar with technical analysis, the only limitations of the indicators you can utilize are your own perseverance and imagination. Speaking of imagination, here's a cool thought experiment I remember doing back in my freshman year in university. As I was getting more and more interested in AI, I was daydreaming about how I could use it to become rich fast. The idea was that if I could just build a machine learning model that takes into account all the relevant data that affects the price of stock, I could theoretically become a billionaire overnight. Here's how. Imagine I had God-tier coding skills and built a machine learning model that not only pulls in live pricing data, but also searches the web to find every Reddit post, news article, and any other information related to the company I could find, with the ability to constantly update all the data in real time. If I had enough data, I could theoretically predict its price movement with almost perfect accuracy. For example, I could know what the market sentiment about the stock currently is by performing natural language processing on millions of Reddit posts. I could also have the data to know how specific news articles and Elon Musk tweets affected its price in the past. Eventually, I could create an extremely sophisticated model that combines fundamental analysis with market psychology to basically create a time machine for that stock. Then I realized that this would be nearly impossible to build in the real world. There are too many variables that could affect the price of a security, and even if we could find all the relevant data, it would require a supercomputer that probably doesn't even exist to process it. Or maybe I'm totally wrong, and there might be a better way to make these predictions that already exist. Let me know in the comments below. I'm not an expert in this field, so I'd appreciate learning something new. One area that traders strongly believe TA has an obvious advantage in is crypto. Since crypto markets are highly volatile and generally speculation-driven, TA provides investors with key indicators of price movements, especially support and resistance zones. Fundamentals are unclear in the crypto market since it operates differently than equities and other asset classes. CoinDesk says, "True believers say TA is even more important in crypto markets since nobody can really yet confidently pinpoint the fundamental value of Bitcoin, invented by a small cadre of libertarian computer coders just 11 years ago. Is it a store of value, an inflation hedge, a digital form of gold, the future of money, or simply the rewards for the owners and operators of the computers that are helping to keep the world's biggest blockchain running? It might be all of the above." Without fundamental news, relying on charts and prices and volume become the best bet for crypto traders. Okay, so now let's talk about the haters. It's usually more fun anyway, because as much as some traders treat technical analysis as the holy grail of finance, others won't touch it with a 10-foot pole. Critics of TA believe that history doesn't repeat itself exactly, so looking only at price patterns is a waste of time. Technical analysis operates solely by looking backward. Those who dislike TA believe that past market movement tells you nothing about what lies ahead. Yesterday's movement has no influence on today's or tomorrow's. Critics argue that if you could predict the future by looking at the past, wouldn't everyone be using them? And then they would get priced in and likely wouldn't work anymore. Plus, when the markets are being manipulated by, say, the Fed, technical analysis theory ceases to function altogether because it's no longer investor psychology driving the market. Or take the recent collapse of the FTX exchange. What indicator could predict that? Which is another reason some investors loathe technical analysis, the sheer number of indicators possible. Almost infinite. Throw enough darts at a board, and you're bound to hit the bullseye eventually. Not because of strategy, but because of sheer luck. Some claim that TA has no scientific value, equating the predictions analysts use to astrology and horoscopes. The human brain will find patterns even where none exist, and the visual nature of TA charts appeals to our brains in a way that makes it even easier to find meaningless dips, cups, and trends. Many claim that in the cases where technical analysis does seem to work, it's only because of a self-fulfilling prophecy. When traders see a bullish pattern, they all buy in expecting the market to go up, which makes the market go up. If they see a pattern that they believe marks a downtrend, they sell like crazy and prices go down. Eventually, when their predictions actually come true, it leads them to believe their charts were reliable. If enough people use the same indicators, technical analysis becomes an analysis not of the actual market, but of technical analysis itself. That's some weird inception, man. Technical analysis can also leave room for bias, where our brains begin picking out patterns based on subconscious biases about the companies behind the ticker and our hopes for movement. For example, we want Tesla to go up because of our crush on Elon Musk, so we cherry-pick the indicators that support Tesla's growth and ignore everything else. To better show you how this bitter love-hate feud over technical analysis can play out, let's look at an example. Technical analysts find their preferred indicators and stick to a handful that they use each day to make decisions. One of the most common indicators analysts use is the accumulation distribution line. This is used to determine money flow in and out of a security and considers the trading range and where the closing price is in relation to that range. If the indicator line is trending up, it shows buying interest since the stock is closing above the halfway point of the range. If the line is falling, it shows the price is finishing in the lower portion of its daily range, which indicates a downward trend. An analyst using the AD line indicator to chart, let's say, an auto manufacturer stock, could see a confirmed uptrend, make their trade, and walk away with a profit. Their belief in technical analysis is confirmed. Another analyst, using the same indicator, but a chart that looks at a different time frame for the security, could see an entirely different trend. Their analysis fails to account for a recent merger, and because they believe the current price reflects all relevant information, they don't even know what's happened. Their trading decisions result in a loss, and they declare technical analysis a waste. My personal opinion is that fundamental analysis is by far the better way to make money in the market. It's more reliable and easier to predict. If someone could actually build a model that accounts for potentially trillions of different indicators that could affect a stock price in real time, then maybe, just maybe, fundamental analysis could become a tool of the past. But I don't see that happening in my lifetime. I think index funds are the way to go if you want to pretty much guarantee a lifetime of building wealth. Check out this video on your screen to learn all about index funds.